Hi guys, welcome back. Today we are going to talk about the 4 keys to using multiples. This is a continuation of our discussion in relative valuation. Again, what is relative valuation? It is a technique in estimating value that gives reference to similar assets in the market. We use their prices as the basis for the valuation. In relative valuation, we have to rely in multiples to scale stock prices to a common denominator. As such, we have to be careful in selecting, analyzing, and using them. According to Aswat Damodaran, there are 4 keys to using multiples. So that we may use them properly, we should do the following tests. We have the definitional tests, descriptive tests, analytical tests, and application tests. We'll go to them one by one. First, the definitional test. I am going to use the PE ratio as an illustration for these 4 basic tests. What is the PE ratio? What do we mean by the PE ratio multiple? The PE ratio is basically the ratio of a company's stock price to its earnings per share. At first glance, it may appear that the calculation of the PE ratio is straightforward and everybody would agree on what that means. However, when we go into the details, such as what do we mean by EPS, the earnings per share, there are actually a lot of versions of the PE ratio. If we are going to use the last 12 months of the earnings per share, we're going to arrive at the trailing PE ratio. Meanwhile, if we're going to use the projected earnings per share 12 months into the future, that is actually called the forward PE ratio. And furthermore, what do we mean by earnings per share? Is it the basic earnings per share or the diluted earnings per share? With this illustration, you can appreciate why it is important that we make the definitions clear. Furthermore, the ratios should be consistent. Equity measures should pertain to equity value, while enterprise measures should pertain to enterprise value. We have to make an apples-to-apples type of ratio. When it comes to consistency, refer to the following examples. The price-to-earnings ratio. This is the ratio of the share price to the earnings per share. If we multiply both the numerator and the denominator by the number of shares outstanding, it can also be expressed as the ratio of equity value to earnings. Note that the equity value is of course an equity measure, and earnings or net income after tax, the interest has been deducted, and as such, it is also an equity measure. This is therefore consistent. Another example, we have the EV to EBIT, which is the enterprise value to earnings before interest and taxes. The numerator enterprise value is obviously an enterprise measure. EBIT is also an enterprise measure because interest is not yet deducted. This amount would be distributed to both the debt holders and the shareholders, considering again that interest is not yet deducted. Again, this is a consistent ratio. A very common ratio that's being used, which is not consistent, is the price to sales ratio. This is the ratio of the equity value to sales. This is inconsistent because price is an equity value while sales is actually an enterprise measure. Because of this, there would be a problem if you would compare the price to sales ratio between a company which has no debt and a company that has a large portion of the funding coming from debt. Next, we have to ensure that the multiples are uniformly defined. This is an issue when it comes to accounting. What accounting policy is used? For example, for depreciation. Is a straight line or the sum of the years depreciation being used? What is the assumed useful life of the machine or equipment? Is it 10 years or 8 years? Policies and estimates like this will compromise the comparability among multiples. Company with depreciation calculated using the straight line method will have a higher profit than the company with depreciation calculated using the sum of the years method in the earlier years of the machine. Third, we have the descriptive test. What makes a high PE ratio? What about a low PE ratio? Note that the multiples in a particular sample or population of companies are not really forming a normal distribution. Why is that so? Because multiples can be as low as 0, but as high as, who knows how high? 500, 1,000, or even 100,000. As such, you would notice that if we are going to take the population of all PE ratios of the companies in the world, we are going to have not a normal distribution, but a skewed to the right distribution. Because of this, in selecting a measure of central tendency, maybe it's inappropriate to use the mean. Maybe the median would be more appropriate. The mean will be skewed by the outliers further right. Next, we have to perform the analytical test. In the case of PE ratio, if the PE ratio is high, what could be the reason? Well, we all know that high PE ratios tend to be overvalued, but we should not be quick to judge it as such. There are a lot of reasons that could contribute to a higher PE ratio other than overvaluation. Maybe the price deserves to be high. Let's go back to the dividend growth model to understand what makes the price or the value of the stock higher. P sub O, the current stock price, is equal to D sub O times 1 plus G. This is the calculation of the dividend next year, over R sub S, the required return of the stock, minus G. Now, as you can see, it is possible that the P sub O would be high. It is because there's a high growth rate, and or the dividends are high because of a higher payout ratio. Again, before judging a company to be overvalued on the basis that it has a high PE ratio, it could be the reason that the company's stock price deserves to be high. Finally, we are going to perform the application test. How are we going to use the PE ratio as a multiple? Of course, we have to compare it with comparables. Of course, we have to compare the company's PE ratios with that of the comparables. The process has been discussed in the previous discussion. Furthermore, we have to control for differences. How are we going to control for differences? There are at least 3 ways to do this. Number 1, we can make a subjective adjustment. Say for example, the growth rate of the company tends to be higher than that of the industry. We would consider its high PE ratio as something fairly valued, even though it is higher than the industry average, accounting for the fact that it has a high growth rate. The problem with this is that this may lack objectivity. Another way of doing it is through the use of the modified multiples. Actually, we can perform a calculation that would account for growth rate for a high PE ratio company. Instead of using the PE ratio, we can use what we call the PEG ratio, PEG, adjusting for the differences due to the growth rate. Finally, statistical techniques, for example, regression analysis, can also be utilized in accounting for the differences among multiples. So these are the 4 basic tests in using the multiples. Again, as always, please like, share, and subscribe this video. Like, share, and subscribe. This for